Welcome, friends. Let us learn one particular section of Income Tax Act. This is Section 80 IAC, which deals with tax exemptions to startups. 80 IAC, in fact, applicable to certain kind of eligible startups. And there are certain conditions associated with this particular section. And this is a good section for tax planning purposes. In a period of 10 consecutive years, in a period of 10 years, a startup entity, if it's eligible, can claim complete tax exemption for a consecutive period of 3 assessment years. Let me share my screen to explain you all these things in detail. Just give me 1 second for that. I think screen is visible right now. Please look at the screen. Yeah, if you look at the screen, you can understand. Look at this chart. In fact, only companies or limited liability partnerships. These are the two kinds of entities. If they're startups, if they're eligible startups, they can claim exemption. So it is very clear that registered partnerships cannot claim exemption under this section. Only companies and LLP can claim. And these companies and LLP must be considered as eligible startups. What is an eligible startup? We'll be learning shortly. And they must be doing some kind of eligible business. So that also we are going to learn. And if they're eligible startup and doing some eligible business, the 100% of tax deduction is applicable, can be availed by them. And this 100% tax deduction is available only for 3 consecutive assessment years out of 10 assessment years. So this we'll be also discussing about this period. And friends, when I say 100% tax deduction, I mean tax which is payable on its business income. That means the deduction is not applicable to capital gains. This is not applicable to income from other sources. Now, first, let me summarize the conditions. The one of the major condition is that the startup that we're talking about should not be formed or should not have been formed by splitting off or restructuring some existing business. That means it should be new startup. And again, the startup must not be using any old plant and machinery. So the startups business not be dealing with transfer of old plant and machineries, meaning it should not have used some old plant and machinery. There are certain exemptions which we are going to learn. And if you're thinking about what is this eligible business means the startup must be dealing with some kind of innovation, development, improvement of the products, processes, or services, or it should have some kind of scalable business model with high potential of employment generation or wealth creation. This concept has been explained in the Income Tax Act. We'll be learning all these things in detail. And if you talk about what are these eligible startups, so as I told you, first of all, it should be a company or LLP. One more important condition is that it should have been incorporated after April 1st, 2016, but before 1st April 2025. So government keeps on extending this period, but as of now, the period is like this, as of today. So its startup must have been incorporated during the period 1st April 2016 to 1st April 2025. And also you have to check the total turnover of that startup should not be exceeding rupees 100 crores. And the startup should be having one certificate about eligible business. That also will be seeing that what kind of certificate is required and how this certificate can be obtained. Now, friends, one by one, we'll be seeing some of the sections. So first, once again, let me summarize what is this section 80 IAC. As you have seen, you can go through the slide, which is, you can read the content of the screen. Section IAC, subsection 1, clearly talks about that 100% tax deduction is available. It says if you see a deduction of an amount equal to 100% of the profit and gains derived from such business for 3 consecutive assessment years. And also this section is talking about it is applicable for eligible startups, right? Profit and gains and from eligible business. These are the 3 points one has to see. And these 3 consecutive years means 3 consecutive years out of 10 years, beginning from the year in which the eligible startup is incorporated. So this period of 10 years is discussed in subsection 2. So this is what we have to remember. And in the meantime, let us see these conditions which I had told you earlier. Should not be formed by splitting off or reconstruction of a business which is already in existence, meaning business should be a brand new business. But however, there is one exception. If the reconstruction is something, reconstruction is a kind of reconstruction which is, or a kind of reconstruction which is mentioned in the section 33B. That means due to, let us say, flood, some kind of natural calamities. Section 33B, if you go through, you can learn that. Floods, fire accident, riots, enemy attacks, those kind of reconstructions are exempted. Otherwise, this startup should not be formed by splitting off or reconstruction. And it should not be formed by transfer to a new business of plant or machinery previously used for any purpose. That means the plant and machinery should be new plant and machinery, which is used in the startup. Old plant and machineries are not allowed, but there are some exemptions to this particular provision. Let us see that exemptions. Now it might be coming to this question might be coming to your mind that whether old plant and machineries are not allowed at all. No, certain situations it is allowed, but up to a certain limit and subject to fulfillment of certain conditions. If you go through the explanations of this particular section, it says that any machinery or plant which is used outside India by any person other than the assessee shall not be regarded as a plant and machinery previously used. That means for this purpose, if there is some plant and machinery, it may be an old plant and machinery. But if it is used outside India and not by the assessee, some other person was using, that will not be treated as old plant and machinery. That will be treated as good as new plant and machinery. Condition is that it should not be used, it should not have been used anytime before its installation in India. It should not have been used in India. That is first condition. And it must be imported to India. And third condition is that no depreciation should have been taken on this planted machinery earlier in India. Okay, third condition, if you see, no deduction on account of depreciation in respect of such machinery or plant has been allowed or allowable under the provisions of this Act in computing the total income of the person for the period prior to the date of installation of the machinery or plant by the assessor. So before installation, no depreciation should have not been allowed. That means if someone is using a machinery, let us say in India, it is exporting it, again importing back. Deduction under this section is not allowed. Okay, because it is used earlier in India. Depreciation might have been claimed on that plant and machinery also. On that ground, deduction will not be allowed. So this condition has to be taken care of. One more relaxation is also available. If at all some used plant and machinery assessee is using, even if those plant and machinery are used in India, still deduction is applicable. Deduction is allowed, provided this used plant and machinery should not constitute more than 25% of the total plant. This is one more explanation which is attached to the provision. You can go through this explanation. So used plant and machinery can be used, but it should be within 25% of the total plant and machinery. Right. So if someone is using 75% of new plant and machinery and 25% of old plant and machinery, still deduction under this section is allowable. That we have to keep in mind. Now, friends, for the beginning, we had talked about this eligible business. So I had told you that business should be dealing with some kind of innovation, development, improvement of products and services, and should be a scalable business. All these things are discussed in subsection 4. If you see the explanation to subsection 4, here is the provision. Eligible business means business carried out by an eligible startup engaged in innovation, development, or improvement of products or processes or services, or a scalable business model with high potential of employment generation or wealth creation. So these businesses shall be considered as eligible business. Startups should be doing this kind of business. Then only it is eligible to get the certificate and to claim for this exemption. And what is eligible startup? This is also explained in this explanation. It talks about a company or LLP. Look at here. It is a company and LLP. Second condition, it says should have been incorporated on or after first day of April 2016, but before first day of April 2025. This is the period. And the total turnover of its business does not exceed 100 crore in the previous year relevant to the assessment year. So you have to see the total turnover of the previous year. And it must be holding a certificate of eligible business from Interministerial Board certification. We'll be seeing where from one certificate can be obtained. So these are the conditions of eligible startup. So to claim exemption, one should be an eligible startup and must be doing some eligible business. This is what I'm showing you the screen. It is that certificate which is popularly called as DIPP certificate. You can see the certificate of eligible business, which is issued under Section 80 IAC of Income Tax 1961. It is issued to a particular company which is incorporated in this period. Right. So you can have a look at this certificate. If the certificate is available, then 80 IAC benefit can be obtained. How to apply for the certificate? So you can go to the website of startupindia.gov.in. You can go this tab recognition. You can find one more tab, sub tab, apply for DPIIT recognition. Right. You can apply online. You will be requiring to upload certain documents. Right. So if you see the condition, it says the private limited company or registered partnership or an LLP can apply. So this talks about the startup registration. Startup can be registered and even a registered partnership can be registered. But this particular deduction is not available to a registered partnership. You have seen the section, it is available only to companies or LLPs. These are the documents one will be requiring to get that certificate. Memorandum of Association or LLP deed, board resolution, annual accounts, income tax returns. Right. Then startup video link, pitch deck, some documents will be there. If you go to the website, you can see the list of the documents which will be required. You can go to the website like this. Again, I repeat, startupindia.gov.in, recognition. Then you see income tax exemption notification. If you click here, you can look at the entire notification. What are the documents which are required are listed there. So if the startup is doing some eligible business, and if it's an eligible startup, it will be good tax planning to use the benefit of this particular section. Right here, you see income tax notification. Entire notification is available in the Startup India website, so you can see the entire thing. One need to visit to the website startupindia.gov.in. So, friends, I think you got a fair idea about how to use this particular section to get complete exemption of your income tax, which is payable on the profit and gains of business of profits. I repeat, this exemption is only available to the business profits, not for capital gain and not from income from other sources. And this is again applicable only for eligible startups, which are companies or LLPs, and which are incorporated during a particular period. Right? So these things you should keep in mind. Hope this video will be useful to you. Thanks a lot. Thank you.